A weakening dollar trouble for Asia. The US dollar is losing value. This is a big deal for the global economy, especially for Asian countries. Asian currencies are closely tied to the dollar. When the dollar falls, their currencies often weaken too. This can make it harder for these countries to pay for imports, potentially leading to inflation. A weaker dollar can also hurt investors. Many investors hold assets in dollars. As the dollar declines, these assets become less valuable. This can lead to reduced investment in the region. Governments and central banks in Asia are closely watching the situation. They are taking steps to try and stabilize their currencies. The situation is complex and constantly evolving. It remains to be seen what the long-term impact of the declining dollar will be. Hong Kong's currency, the Hong Kong dollar, is pegged to the US dollar. This system has been in place for decades and is meant to provide stability. However, the declining US dollar is putting pressure on this peg. The Hong Kong Monetary Authority, HKMA, the city's central bank, is tasked with maintaining this peg. To keep the peg stable, the HKMA has been intervening in the currency market. It has been selling US dollar reserves and buying Hong Kong dollars. These actions are designed to increase demand for the Hong Kong dollar and keep its value up. The HKMA's interventions have been largely successful in the short term. However, the continued decline of the US dollar poses a significant challenge. Taiwan and China are also facing significant challenges due to the weakening US dollar, which has been a dominant force in global finance for decades. In response, Taiwan's central bank has strategically allowed its currency, the new Taiwan dollar, to depreciate against the US dollar. This move is aimed at maintaining economic stability and supporting local industries. This depreciation is partly due to pressure from exporters who benefit from a weaker currency, as it makes Taiwanese goods more competitive in the international market. However, a weaker currency also has its downsides. It makes imports more expensive, which can lead to higher costs for consumers and potentially drive inflation. This is a delicate balance that the central bank must manage carefully. China's situation, on the other hand, is more complex and multifaceted. The country has a different approach to managing its currency. China manages its currency, the yuan, through a controlled float system. This system is designed to provide stability while allowing some flexibility in the exchange rate. This controlled float system allows the yuan to fluctuate within a certain band against the US dollar, providing a buffer against sudden market shocks. However, to maintain this balance, China's central bank frequently intervenes in the market to manage the yuan's value, ensuring it does not deviate too far from the desired range. The declining US dollar has put pressure on the yuan to appreciate, which poses a challenge for China's economic strategy. A stronger yuan could hurt Chinese exporters by making their goods more expensive on the global market, potentially reducing demand. To counteract this, China's central bank has taken several steps to slow the yuan's rise, including setting a weaker daily reference rate for the currency. This is part of a broader strategy to maintain economic stability and support the country's export-driven growth model. Several factors have contributed to the US dollar's decline. One major factor is the ongoing trade war between the US and China. The Trump administration imposed tariffs on billions of dollars worth of Chinese goods. China retaliated with tariffs of its own. These tariffs have disrupted global trade and created uncertainty in the markets. This uncertainty has led investors to move away from the US dollar and into other assets seen as safer or more stable. The tariffs have also hurt the US economy, making the dollar less attractive to investors. Another factor contributing to the dollar's decline is the increasing US budget deficit. The deficit has grown significantly under the Trump administration, partly due to tax cuts. A larger deficit can lead to inflation and weaken the dollar. Section 5 Market Mayhem, from Wall Street to Shanghai. The financial world is in turmoil and the effects are being felt far and wide. The declining US dollar has sent ripples through global stock markets, causing a wave of uncertainty and concern among investors worldwide. The US stock market, as measured by indices like the S&P 500 and Nasdaq, has experienced significant volatility in recent months. Traders and investors are on edge, watching every movement closely. Some investors see the weaker dollar as a sign of economic weakness, sparking debates and discussions among financial analysts and experts. This perception can lead to selling pressure on stocks, as investors rush to offload their holdings to avoid potential losses. Asian stock markets have also been affected, with the ripple effects of the US dollar's decline reaching across the Pacific. The weaker dollar has hurt the earnings of some Asian companies that do business in the US, impacting their profitability and financial stability. The uncertainty surrounding the trade war and the dollar's future has also made investors more cautious, leading to a more conservative approach in their investment strategies. The currency fluctuations and market volatility are causing concern among investors and businesses alike as they navigate this unpredictable financial landscape. Companies are finding it harder to plan for the future when exchange rates are unpredictable, making long-term strategic planning a challenging task. Investors are grappling with the potential impact on their portfolios, seeking advice from financial advisors to mitigate risks and protect their investments. The global financial community is on high alert, watching and waiting for the next move in this complex economic dance. Section 6. Central Banks Fight Back. A look at the measures. In this section we delve into the various strategies and actions taken by central banks to counteract the economic challenges posed by a declining US dollar. Central banks in Asia are taking steps to try and stabilize their currencies and mitigate the impact of the declining US dollar. These measures are crucial as they aim to maintain economic stability and investor confidence in their respective countries. These measures vary from country to country, but often involve intervening in the currency market. This intervention can take many forms, including direct buying and selling of currencies to influence their value. As mentioned earlier, the HKMA has been selling US dollar reserves and buying Hong Kong dollars to support its currency peg. This action is part of a broader strategy to ensure that the Hong Kong dollar remains stable and predictable. Other central banks in the region have used similar tactics. For instance, the central banks of Japan, South Korea, and Singapore have all engaged in market operations to support their currencies. They are buying their own currencies in the market to increase demand and prop up their value. This approach helps to counteract the downward pressure on their currencies caused by external economic factors. Some central banks have also adjusted interest rates to make their currencies more attractive to investors. By raising interest rates, they can offer higher returns on investments denominated in their currency, thereby increasing demand. These central bank interventions can be effective in the short term. They can provide immediate relief and stabilize the currency markets temporarily, buying time for longer-term economic adjustments. However, they come with risks. The effectiveness of these measures can be limited, and they may not address the underlying economic issues. Selling off foreign currency reserves can deplete a country's reserves over time. This depletion can leave the country vulnerable to future economic shocks and reduce its ability to intervene in the market again. Adjusting interest rates can have unintended consequences for the domestic economy. Higher interest rates can slow down economic growth by making borrowing more expensive for businesses and consumers, potentially leading to a slowdown in economic activity. Section 7. The Global Web of Finance. Why we're all connected. The current currency fluctuations highlight the interconnectedness of the global economy. What happens in one part of the world can quickly affect markets and economies on the other side of the globe. The US dollar's role as the world's reserve currency amplifies these effects. When the dollar moves, it sets off a chain reaction in currency markets worldwide. Countries with currencies closely tied to the dollar, like many in Asia, feel the impact most acutely. The interconnectedness of global finance means that central banks and governments must work together to address these challenges. Coordinated action can be more effective than countries acting alone. However, achieving international cooperation can be difficult, especially in times of geopolitical tension. Section 8. Charting a course strategies for stability. The declining US dollar presents challenges for Asian economies, but there are strategies that central banks and governments can pursue to navigate these turbulent waters. One approach is to diversify foreign currency reserves away from the US dollar. Holding a basket of currencies can reduce a country's exposure to fluctuations in any single currency. Another strategy is to promote greater use of regional currencies in trade and finance. Reducing reliance on the US dollar can lessen the impact of its fluctuations. Long-term, strengthening domestic financial markets can make a country less susceptible to global shocks. The path forward requires careful planning, coordination, and a willingness to adapt to the ever-changing global financial landscape.